let's move on then, and let's talk about part two, Q&A. And of course, this is where I want to spend a bit of time tonight talking about what's going on with coronavirus, financial markets, etc. Now, this isn't a substitute for sort of a more intense deep dive that I'm going to be doing. And I should say out of the gate that this, in these days of litigious anxieties, it's not financial advice, it's general discussion for educational purposes only. So I really love this cartoon, which someone sent me on Facebook a while ago, and I had to hunt up today. So be sure to wash your hands and all will be well. You've got COVID-19 there, but looming behind it is a much bigger wave that is going to potentially cause even more devastation. I'm mindful right now of this phenomenon like a stampede where people get spooked and they trample other people to death. And it makes no sense because we can all exit, no worries, there's no hurry. But when you hear about fights breaking out in supermarkets over toilet paper, it's got that sense of a stampede and a sense of panic. Now, the problem with panic tends to be the response is more dangerous than the root danger to begin with. So our response to this COVID-19 virus is in many ways going to create a second wave, a recession wave that will be potentially much, much worse than the first wave. It may last longer and it might be more devastating to people. For instance, we're anticipating that maybe 100,000 people in Australia might get the virus and might get quite sick from it, but we're anticipating millions of people might be out of work. So whatever the impact of the virus is, the bigger wave that's sort of sitting behind it is what's partly being seen at this point in time, but which I think is increasingly becoming more certain and will have a much bigger impact on people. Now, I don't know how you were at the start of this. I was underwhelmed to the point of ignorance about just how bad this would be until probably about 2 weeks ago. 2 weeks ago, the penny dropped for me that, hang on a second, if people are fighting about toilet paper in supermarkets now, then the human response to what's going on is probably going to be pretty drastic. Since then, we've had countries closing borders. We've had today the Australian government saying don't travel overseas, and if you're overseas, get home now because we don't know how much longer the border is going to be open for. We've got businesses being told to shut, and so effectively starting from now, people are going to be laid off, and most people don't have much money to be able to survive. They just don't, and or if they do, they might hold their wealth in assets that aren't liquid, and therefore, if they need money, they might be asset rich but cash poor. So there's a lot that we need to prepare ourselves for here, and I'm not talking about the health aspects of it today. That's Leanne's area of expertise. It's not my area of expertise. The best advice I can give you there is follow what the experts say. But when it comes to money, that is actually my wheelhouse, and I've lived through the 87 stock market crash. I remember that very, very well. I was in year 10 at the time playing a stock market game where I was the stockbroker and other people in the classroom were the investors. And then I remember the 1990s recession because I was out there trying to get a job. And I remember very, very well, obviously, the 2009 to 2012 crash, particularly as it applied in the United States of America, and just seeing the absolute financial devastation. Like, we didn't see any of it in Australia. I'm talking about banks with signs on it, we're still open for business. 100% of the people that I knew had lost money catastrophically. So there's a possibility we might be in that boat when it comes to Australia. There's even the possibility that people might start worrying whether the banks are safe and maybe even trying to go and grab their money out of the banks, which, as I made a Facebook post today, is one of the reasons why reserve banks around the world are effectively pumping money in so that people are worried about toilet paper. How much more worried are they going to be if their savings aren't accessible? So basically anything and everything is on the table at the moment. But as we'll see in a second, the real damage here will be the economic damage. Now, it might be a short, sharp 4 to 6 month economic contraction that might then take as long again before the economy tools back up again and re-gears. Uh, Best case scenario I see at the moment is a year from now, we're sort of dusting ourselves off and just looking around, much like a cyclone, wondering where's the damage and how do we repair it. Worst case scenario is that we actually enter into something which would be the equivalent of a depression, and people's wealth, particularly self-funded retirees, evaporates almost entirely because asset values just go into panic selling, and there's massive price dislocation because people are selling, but there aren't people buying. Now, I'm not forecasting that to happen. I've rubbed the crystal ball and I've thought ahead, and it's a possibility, but much like when we were talking before about the bell curve, that's an outlier. We'll have to wait and see what's going to happen, but it's going to be turbulent and it's going to be volatile. You're going to wake up some mornings and the optimists are going to have won that night on world financial markets, and you're going to go to bed some mornings and wake up, and it's going to look like the end of the world financially because the pessimists have won. And all I would say is it's a very brave person, truly, that would take a position in the current market that is a long position because there's so much uncertainty right now that the only thing you can be doing if you're buying for the long term is you must be speculating and just thinking that this will pass one day, and you're just hoping that whatever you buy won't be smacked down badly. So coming back to some slides for you, here is a slide of the All Ordinaries Index. That fly is, it's not a fly, it's a beetle, it feels like. And this isn't quite right because the market actually ended up closing below 5,000. So when I did this slide earlier on today, it was sitting at about 5,050. So what this slide is designed to do is to demonstrate that values today, if we trace it all the way back, have returned from an index point of view. And it's not every stock in the index, but from an index point of view, back to 2013, mid 2013 prices. So in other words, all the gains that have been made since mid 2013 on this index have been wiped out. And that's a problem because if you've entered into the market basically since 2000, well, since 2013 really, you're now sitting on losses, or alternatively, you're back to a neutral position. And that's going to hurt because there's so much money in financial markets, superannuation funds, etc., that it's people aren't going to have the money that they used to have, and therefore think about it. If you don't have the money that you had and you're retired, then that must mean that the quality of your life in retirement is going to suffer. You're going to have to rely on the pension because you're not going to have the risk profile and all the time to be able to make back this money. While if you're young, you might be able to jump in and speculate on XYZ stock that a year from now it's going to be recovered. If you're down to your last $100,000, you can't put $100,000 on XYZ shares hoping it's going to bounce back, because if it doesn't, it's a total catastrophic loss. You don't have money to play with like that. So the young people who have got time on their side usually don't have money, and the older people who have money on their side generally don't have time on their side. So again, at the outlying extremes of the people who are going to watch what happens and either get spanked or miss out, it's the people who right now have been, we come back to the principles before, smart with their money, spending less than they've earned, saving, and have that money available to deploy. They're the ones that can stand to make a lifetime's worth of wealth out of what's happening in the market. So there's two parts to this. There's a protectionist part, capital preservation, and there's a money multiplying part as well. Now, I think it's premature for the money multiplying part to be played out. I think for me, I'm about capital preservation at this point in time, particularly with my own money. And for instance, one of the things that I'm doing is I'm looking at where I've got bank accounts more than $250,000 or more in those bank accounts, and wondering, should I open up another bank account in another bank, another Australian bank? If I've got ABC Bank, go to DEF Bank, open another bank account. So if I've got $500,000 in one bank account, what I'm doing is splitting that into two bank accounts of $250,000. Why? Because the government guarantees deposits up to $250,000. Now, I wouldn't be surprised if they go back to a GFC type policy where they guarantee deposits up to $1 million. But at the moment, it's not like that. And you only need one run on one bank if you hear the XYZ bank is running out of money. And then, my God, you will not have seen panic in your life like it'll be with people running to the banks to try and get their money out. And the second that banks start limiting the amount that you can withdraw, um, it really is the beginning of the end. Now, I'm not suggesting that you go out and take your life savings and stick it in your mattress or anything else like that. I'm just forewarning you that um, basically it's prudent to be prepared at this point in time, and it's prudent not to assume what was right yesterday will be right tomorrow, because things are changing very, very quickly. I mean, could you imagine a situation a month ago where Australia would have closed its borders to people trying to get in and get out? It's unfathomable. But I want you to see how quickly values have come off here, because, at the end of, I think it was the 20th of February, 3 weeks ago, the market was at an all-time high, and 3 weeks later, we've now lost effectively 6 years worth of value on the All Ordinaries Index. Uh, and it's a worry. I feel, and feelings are sometimes dangerous, but I can't help but feel that there's sort of a financial earthquake that's going to rip through markets. With the potential for mass unemployment, the potential for millions of people to be out of work almost instantly, it's not unfathomable to see markets fall. In the US, the maximum they can fall in a day is 20% before the markets close. We've seen 10% or slightly higher falls in a day, and you've seen them bounce back, but they're not bouncing back by as much as they're falling, which means that the pessimists rule and the optimists come in, but the optimists don't. It's an arm wrestle. The optimists don't win, and the pessimists come back in the next wave. So it's wave after wave after wave down. So it's not too inconceivable to believe that the stock exchange might get back to 4,000 or 3,000 or 2,000 before this is played out. And of course, not everyone's going to survive on the stock market. There's going to be an increased amount of insolvency because businesses have overheads, but they won't be making sales. And if they don't have lines of credit that they can draw down on, they're going to close. And I can't help but, again, not putting the moz on anyone, but something like a Virgin Airlines that is foreign owned and not particularly well capitalized in terms of its value on the stock market. I've got a mountain of frequent flyer points. I'm cashing them in because I don't trust that the frequent flyer points program is necessarily going to last this coronavirus. And if it does, I can rebuild it again. And the reason I say that is because I remember when Ansett went broke almost overnight and their loyalty program collapsed. And I had tens of thousands of Ansett loyalty points that I didn't use. So you've got to look and you've got to ask yourself, what are the assumptions that I make based on how I think the market's going to perform, and ask yourself, are those assumptions that I'm making safe assumptions to make in the current market? And we haven't seen mass price dislocation in real estate yet, but I think we will, and I'll talk about that in a moment too. So I want you to consider these three elements. First of all, you've got Main Street. Now, Main Street are your businesses that you're buying and selling, just normal businesses transacting. You've then got what's called Wall Street. And Wall Street is made up of investors and speculators. Now, Main Street and Wall Street exist in every market. You've got the businesses and you've got people that own the equity in those businesses. And then you've got people that like to speculate. They don't want to necessarily own the business. They don't like the story, but they see the opportunity to make a profit. So they're willing to speculate. So you've got Main Street, you've got Wall Street, and you've got one other street, which is No Street. And these are the people that don't live on Main Street, don't interact on Main Street or Wall Street. They just live on No Street. They're just people that come to work, don't have much investments. And I'm what's that saying? There's always people who wonder what happened, ask what happened afterwards, and people that take advantage of what happened. I'll get the quote for next week if I remember. But where do you sit on Main Street, Wall Street, or No Street? Because where you sit depends on the action you should be taking right now. There are businesses on Main Street that won't survive. There are investors on Wall Street that are going to cop a pounding because they've got yesterday's investing strategy they're trying to apply today. You've got speculators that are just jumping in based on gut feel often, who add a bit of noise. And then you've got people on No Street which will just have to survive and react as best they can financially moving forward. So with that in mind, let's take a look at this stock. Now, I've used Qantas just as an example. Remember, this is not advice. I'm not a share expert. Really, what I know about shares, you should ask and do the opposite, because I have a consistent record of losing sums of money on the stock market. But I do want to use Qantas as an example for illustrative purposes. The first thing I'd say about Qantas is its value a couple of weeks ago was $7.46, and now its value is $2.52. So, it's lost 75% of its value. Now, what is fundamentally different about Qantas's business today versus 3 weeks ago that justifies losing 75% of its value? Well, the answer is it's grounded 90% of its international flights and 60% of its domestic business. So therefore, Qantas, looking forward and looking at its earnings, has dried up. So therefore, while it's got brand recognition and it might be valuable in the future, it's lost its value right now because it doesn't have reliable income streams and is overexposed to the travel industry, which is overexposed to the effects, at least in the short to medium term, of this coronavirus. So now we look down at these numbers and we see this dividend yield, and the dividend yield says 10.56%. So that seems like an amazing return. Who doesn't want a 10% return, right? But that's based on the last dividend. Obviously, if you're not earning profits, you're not going to be paying dividends. So that's historical information that needs to be adjusted. Now, the question we have to ask ourselves is, at $2.52, 75% less than what it was 3 weeks ago, does Qantas, and remember, this is just XYZ stock, illustrative purposes, just putting a name to it to try and give you a context, does that make it cheap? Do you jump in now and go, wow, it was $7.50 rounded, now it's only $2.50, this is cheap? The last time it was $2.50 was way back in 2015. So do you jump in now and do you say, great, I'm going to buy Qantas because I think it's cheap? Well, does the upside outweigh the downside by enough of a margin to take the risk? It's the old risk equation here. And the way I feel about this risk equation is, why would you jump in now when there's so much uncertainty, when you can jump in a month's time, and even if you have to pay more, you've got less risk? So I think it's the speculators and the naive investors that jump in now because they think something looks cheap based on its top value. It's the complete wrong way of thinking. Cheap is relative to the stock's future prospects, not its past prospects. So you've got to look at, hey, would I want to own this stock today at this price? Not because it was something down the track. I mean, there are people that bought Qantas stock at $1.50. For them, $2.50 is still a good outcome. They're still in the money. But if you had have bought Qantas stock at $7.50 and you're still holding it onto it now, hey, you have failed in the mantra of taking losses fast and letting profits run. And a lot of people don't know when to sell because they didn't really know when to buy. They just jumped in speculatively. And because they don't have a strategy, they're just being pounded by the market. So what am I saying here? Cheap honestly is relative, and cheap is relative to the notion of future prospects, not past value. Um, Qantas looks cheap at $2.50, but Qantas isn't cheap if the stock's likely to go to $1.50. And I don't know if it is or it isn't. I'm just saying, to me, it's got more risk on the downside than the upside. And so I would be worried about those industries that are so heavily leveraged or impacted by the coronavirus. So let's talk about recession possibilities for a second. I think it is pretty certain that we're going to enter into a severe economic contraction. I think the economic contraction that we're headed into will be the most severe economic contraction of any of our lives. I think it will dwarf what we experienced in the early 1990s. And even if it is offset somewhat by massive government spending, it's tomorrow's tax revenue that is going to have to be generated to pay for trying to survive today. So the $1 trillion of surplus in the US is going to be run on the back of a huge budget deficit. That has to be paid back by future generations. So even if we lessen the effects today, you you have to understand the way that debt works. Debt isn't money invented out of nowhere. Debt is tomorrow's earnings borrowed and spent today. You don't get the value of that spend tomorrow. You have to repay it. So even if we what am I saying? Even if we lessen the effects of what happens today, we're still going to be left with a debt hangover we have to repay tomorrow. And often recessions are caused by too much spending that has to be repaid by future generations. Remember the recession that we had to have? That's because in the 1980s there was a huge party going on that had to be paid for in the 1990s, and it will be the same now. There is a recession coming on the back of a lack of economic activity, and that recession may then be compounded into a deeper recession, indeed a depression, when we have to start paying back that money into the future. So I don't want anyone to be misguided here and to believe that we're going to fix this by throwing money at it, because all we're doing is amplifying the problem into tomorrow. There is no one-sided fix here. It doesn't exist. If you think it does, it doesn't. It can't. You can't have a one-sided journal entry. The impact must be today or tomorrow. And if you lessen the impact today, you draw out the impact of what's going to happen tomorrow. There will be, I believe, mass unemployment. We're talking about 10,000 people being retrenched at Virgin. We're talking about huge numbers of people retrenched at Qantas, Air New Zealand, United Airlines, Delta. You name it. If you're not flying planes, you don't need staff, and you can't keep staff on your books if you're not earning revenue. Yep, maybe go for a period of time with pay without leave, but sooner or later, you have to slash your costs to survive, and that will be a human cost. And it will mean that unemployment, because there won't be jobs to go to readily, unemployment, I think it just simply must go up. But again, I think this could be a short season with aftershocks rather than like a 5 or 10 year deep recession. I think that the initial impact, how it sits at the moment, might be a 6 to 12 month proposition, with stifled demand for maybe a generation thereafter as we seek to come to terms with this and rebuild economic prosperity. But folks, if you haven't figured this out yet, life as we knew it 3 weeks ago is over. It's gone, just like the 1980s, 1988 is gone compared to 1991. And it happened quick, right? It happened very, very quickly. And it's likely to happen even more quickly from here. And it's happened so quickly that we haven't had time to come to terms with it. Now, you might think I'm doom and glooming, and you might think I'm being a harbinger of the end of the world financially or anything else like that. Hey, I hope I'm wrong. I would love nothing more than to serve myself a double dose of humble pie in a few months' time and go, wow, I didn't see that being this good. And a magic cure comes up overnight and we're all inoculated and we all go back to happy days as it was 3 weeks ago. I just cannot see it happen when you see countries doing things that haven't happened in our lifetime. Cause and effect, right? Einstein's theory of relativity, equal and opposite reaction. When things are happening that have never happened before in our life, you have to expect economic things to flow on that have never happened before in our life. You close down an airline, 10,000 people get retrenched. What do you think's going to happen? You close a country's border. What do you think's going to happen? You hand out $1 trillion. What do you think's going to happen? We're at a scale and a level that has never happened before. And really, we're in uncharted territory, and we're in our generation or in living memory, and we're just trying to make it up as best as we can as we go along. And we're making mistakes, right? The government, I think, is making clear mistakes because they don't know what to do. And one day they're saying handshakes are okay. The next day you wake up, handshakes aren't okay. One day it's okay to send your kids to school. The next day it's not. Um, no one knows what to do here. We're all trying to make it up as we go along. So the natural consequence from mass unemployment will then become mass insolvency. And I'm talking about not only businesses, but also people, because they're going to have debt that needs to be repaid. They're not going to be able to repay it. And unless the government comes out, and in some jurisdictions they've said this, you don't have to make repayments on your mortgage for 3 months. Well, that just kicks the can down to landlords, because landlords probably still have to pay the banks. If you don't have to pay rent, that is, you still might have to pay a mortgage. And if you don't have to pay a mortgage, the banks have still got to pay interest to customers. So someone's going to be left holding the can here. And at the end of the day, if the government bails them out, then they're just borrowing money from future generations. So someone has to pay a price here. You can't get away with giving people money without someone paying a price, or telling people they don't have to pay money without someone paying a price. And then that will lead, of course, to inevitably mass unemployment, mass insolvency, mass wealth loss. I'm talking about phenomenal hurt of people who thought that they were self-sufficient, had their retirement nest eggs, and it's just all gone. They've worked their life, they've been diligent, they've followed the advice of the financial planners, they've got invested in X, Y, and Z, but unfortunately, no one saw this black swan event coming, and they don't have the time or the risk profile in order to try and make it back. And therefore, there'll be a social consequence, which is beyond my realms of being of understanding. But I know that suicides, domestic violence, crime, all escalated in the United States in 2000, and in their downturn, the Great Recession, or whatever they called it. Gun sales went up as people tried to protect their own wealth. We're going to end up with post-traumatic stress, anxiety, depression, marriage breakdown. It's horrible to even think about it, but abusive relationships, child neglect, etc. These are the social consequences of what's going to happen following on from the economic consequences, because the economy is a subset of obviously society. Now, again, I wish it wasn't true. I wish, it kind of sounds like I'm sitting down and telling the patient they've got incurable cancer. But this is what happens. This is the alphabet of A, B, C, D, E, F, G. And we can argue that really, come on, surely D's not going to come after C, but it does. This is what happens. This is what the model says, right? So we either argue with it, we stick our head in the sand and hope it doesn't happen, or we build a strategy and we look at our own situation and we say, okay, righto, you've said some things tonight, Steve, that I hadn't thought about, or maybe I didn't realize it was so serious, or maybe it won't be so bad. But aren't you better off preparing for the worst and hoping for the best than preparing for the best and then being smashed by the worst? To me, it's common sense. So that's why I really want to start helping you as best I can, again, without giving financial advice, to talk through what's going on and to interpret it for you if it helps. Now, again, I'm not always going to be right. You can't expect that. But if you believe that I've got insights that are worthwhile listening to, then I want to try, and not for my benefit and just talking horse until I'm hoarse, but to try and help you survive what's coming and what's going to come. I think it's good for us to be able to continue on talking and fleshing and working these things through. Because one thing I do know is if we stop talking about it and we start internalizing it and we don't have an outlet to go through something together, share the load as it were, then it can actually become quite depressing and quite isolating. And we've actually got a good group with the Property Protege program, and I think if we wanted to, we could really try and help each other out here as best as possible. So just some broad-based rules for today. The first one is Warren Buffett. Be greedy when people are fearful, and be fearful when people are greedy. So right now, it really is a game on time. I for many years, you guys, do you remember me saying this? If it doesn't make sense to buy it, don't buy it. Just hold on to your cash and be patient. It's always a great time to buy a great deal, but if the deal doesn't make sense, don't buy it now because everyone else is jumping in. Just because everyone else is drunk, how many times have you heard me say this, please? Just because everyone else is drunk doesn't mean that you should get drunk as well. It's the sober people who do well while the other people have got a hangover. Is it just me, or do you remember me saying this? I wasn't, the Harry Dent end of the world kind of thing. I was just saying, look, if it doesn't make sense to invest, don't invest for the sake of investing, right? Just make sure you invest if it makes sense. And if you don't, just be patient. Hold cash, pay off debt. The day will come when your prudence will be rewarded, and that day is now. And it's going to get better, I think, for those people who are able to take action. Not in a greedy, opportunistic way, but just in a matter of fact, hey, like Leanne was before, if she's primed to take advantage of the opportunity on offer, then she would be doing herself and her family and her loved ones a disservice if she didn't take advantage of it. And the same goes here. So some little rules to remember. I know they're general at this point in time. They're little reminders, and we will go into deeper dives into this in the time ahead. The first thing I'd say is strategy is needed. You need a double dose of strategy, and you need to inoculate yourself against emotion. Right now in the US property fund, we're doing a redemption, and it's fascinating to see the people who are panicking versus the strategic element of this, because interestingly, there's a really good strategic part and a wealth maximization part, which people who panic often miss out on. Now, I'm not saying anything about the US fund in particular because I need to be very careful about any kind of insider trading or sending signals to the market or anything else like that. I've said I'm not redeeming any shares, and the reason, or any units, and the reason why I'm not redeeming any units is because if it all goes to hell in a handbasket, at least I've got assets in US dollars. And you've seen that the Aussie, if you maybe you don't know, the Aussie currency has fallen 10% now in a couple of weeks. Well, the Aussie could go to 40 or 30 or 20 US cents in an absolute outlier type scenario. It's never been at 20 cents before. It's been at 50 cents before 20 years ago. But wouldn't you want US dollar assets and hedged against it all turning to crap? Like that's where I'm like, people are panicking and they're like, I just want. I'm just like, just stop and think about your strategy. If your strategy is to exit, I've got nothing but support. But if you're panicking, if you're waking up and you're like running to buy toilet paper when you don't need it, I think you've made the mistake of succumbing to emotion. Now, again, I'm not talking about my US fund here. I'm not giving any signals, anything, no advice. I'm simply saying that strategy will always outperform emotion in the medium to long term. So what's your strategy? Do you have a strategy? And if you don't have a strategy, get one. And if you do have a strategy, make sure it's relevant for the market conditions as they are now, looking forward, not as they were yesterday, looking back. Second of all here, preservation. The last thing you ever want to be is a forced seller in a down market. So better to take a loss and live to fight another day than hold on to a loss and starve to death or die of thirst in a desert. So you've got to look at your own survival here to a certain extent and make decisions accordingly. It's fine to make a fortune tomorrow, but you've got to live today. Look at your cash reserves. Could you live 6 months? And that's what we're talking about now. Could you live 6 months with the lifestyle you want to live based on your cash reserves today? That's the question I'm asking myself right now. Could I live for 6 months without suffering a significant drop in lifestyle? And if the answer is no, well, what might I need to do in order to have enough runway to be able to survive those 6 months? The last thing you ever want to be is in a situation where you need cash and can't get it, and you have to sell assets at any price, because that is where people get spanked, and massive catastrophic losses are incurred. All right, so preservation, strategy, preservation, and then we move on to opportunity. And again, opportunity, cash is king. There's no point seeing the deal of a lifetime and not being able to take advantage of it. Now, ideally, you would have been prudent. You would have been following the principles that I talk about to make, manage, and multiply your money. And you would have a storehouse of cash that will see you through preservation and ultimately opportunity. And I'm not just talking about cash, I'm also talking about borrowing ability. Because if you're already maxed out with your borrowing ability, then you're going to struggle to borrow more, right? I've got lines of credit sitting there with effectively very little debt against them, just open, waiting to take advantage of things that are happening. So I've got cash, and then I've got borrowing ability. And that will allow me, when the time's right, when I feel that the upside is now greater than the downside by enough of a margin, to go in and take a pretty massive position, exactly like I did in the US when I bought hundreds of properties in 2000 and when was it, 2010, I think it was, when I bought my first property over there, and I was earning 25% returns buying duplexes in Pine Manor. So I can foresee a time, and I don't think it's today personally. I think the upside's greater than the downside at the moment, but I see a time when that shifts around and the downside is less than the upside, and it's time to take a position. You will need to act, because that window to take action will be quite small. And then when the bounce comes back, it'll probably be most dramatic in the early days, and you want to make sure you catch the most of that bounce that you possibly can. All right, so what about real estate? Okay, here's what I see happening in real estate. So for people that have leveraged positions, highly leveraged positions, whether it's in real estate or more likely in stocks, they might have margin loans and they're getting margin calls. And I'm talking about people that live typically in exclusive suburbs and have holiday homes. When we went through the GFC in 2008, it was the top of the market and holiday homes that were disproportionately priced down. The bottom of the market and the bottom middle of the market held up quite well, first home buyers. It's probably going to be the same now. You're going to start seeing people who are overexposed and over-leveraged having to cash out of their positions to live to fight another day. If there aren't buyers to buy those homes, because as we'll look at in a second, it's going to be harder to finance, harder to get a valuation, and the value on those properties could slip by double-digit amounts or more pretty quickly. As far as auctions go, we've just heard today that gatherings of 100 people or more have been banned, and it's probably in the US, I think it's gatherings of 10 people or more. So it's not out of the realms of possibility that public auctions for real estate will become a thing of the past, and that will mean that the only way that you can transact real estate is privately. There's also the possibility that the government might put a freeze on buying or selling property. That would be radical, but it's possible. In which case, those people that own real estate and need to get out are going to be in a desperate situation, because they're going to want cash and they're not going to be able to get it. So again, these conditions that we're entering into are primed to cause what I call dislocation, right? Just imagine your elbow dislocated and your arm at a funny angle. Well, that's what can happen to price. Things that made sense in the way that assets were priced yesterday doesn't mean that assets are going to be priced that way tomorrow. interestingly, at the end of 1987, when the stock market crash happened, people went to real estate because it was seen as a safer asset. And it took a little while for the stock market crash to stabilize, but people didn't trust stocks when they trusted real estate, and real estate values bounced back up pretty quickly. But then we had the recession of the early 1990s when real estate values were smashed. So again, there might be a second wave after the first wave where the money looks for a safe haven, pumps up asset prices, but those asset prices don't make sense and correct a second time around. Finance and refinance, expected to get a lot harder to get a loan. Why? Because banks are going to start writing off a lot of debt. And that's why bank stocks have gone down in value, because it's going to be harder to make their margin. And there's going to be, remember, the insolvency leading to people effectively going broke, and that will lead to an increase in bad debts, which will then need to be written off, which will then speak into capital adequacy and et cetera, et cetera. It all sort of house of cards falls over. So that's why, again, you need to sort of look at financing and refinancing facilities and maybe talk to someone like Chris Berry. And if you want Chris's details, I'm happy to give them to you again. If you want to talk to Chris and talk about how you can open up a line of credit so that when the time comes to take a position, you've got that facility handy, versus waiting to want to do something and then having to scramble for finance. It makes sense to get prepared now if you can on the finance and refinance side. And then it speaks to valuations. Well, everyone's working from home at the moment, so people probably aren't out there doing valuations. So if you're not going to get a valuation, it's hard to get a loan. If you're not going to get a loan, it's going to be hard to settle. So now you've got all these pre-sales for off-the-plan properties that might fall over. You've got developers with debt positions that they need to make bank on, and they can't because they can't get certificate of occupancies. And so then you've got developers going broke en masse, and again, it ripples through the whole economic system. So you only need one thing to gum up or become frozen or illiquid or immobile, and then the concertina effect is pretty dramatic. So I'm not sure how this is going to play out, because if people can't go places to do these valuations, how does it work? Again, we haven't really been here before to know what's going to happen, but again, it just speaks to this dislocation that I mentioned before. And hence this whole notion of pre-sales, closings. I don't know what's going to happen, but I foresee turbulence, and I foresee people relying on assumptions that they made yesterday and were valid yesterday that won't be valid today or tomorrow. And that's why we've all got to look at our wealth positions and ask ourselves, what are the assumptions that underpin our behavior, and are those assumptions valid moving forward? What would need to happen to make those assumptions invalid? And then consider our position and move on from that.